RIN TV coverage of the 2015 European Insurance Forum is brought to you by the Dublin International Insurance and Management Association. Here at the European Insurance Forum, there has been interesting discussion about the impact of Solvency II. Padraic Joyce moderated a session that suggested that Solvency II is, in fact, a game changer. He is an insurance partner in the PwC Audit Practice. He had this to say.
Solvency II there's effectively three pillars. Pillar one is all about the internal model and the model that has been used to determine capital. A lot of companies have done a lot of work in relation to that. So some work to be done, but at advanced stages. Pillar two is all about corporate governance and getting the right governance structures in place and to be able to meet the governance requirements of the directive. Companies have worked on that. Irish companies in particular have been asked to submit their risk management documents to the regulator by December 14. The regulator is monitoring those at the moment or reviewing them. And they say some of them have achieved the point that was needed, but more work needed to be done on others, particularly in identifying certain risks. Pillar three is about information and disclosure. And I think that because companies have been focused on Pillar one and Pillar two, they've been left with Pillar three and haven't realised how much of a task it will be. So I suspect that that's where the bulk of the effort will be over the next coming months from a regulatory perspective. The impact of Solvency II on capital is quite significant and it will vary from company to company. Presently, capital requirements are determined on a formulaic basis based on exposure or claims experience, whichever drives a higher capital requirement. That's going to change. Companies are going to, based on their own risk framework and based on the diversity of their portfolio, have different capital requirements. For some companies who have good risk management procedures in place and have well-diversified portfolios, they may end up having a lower capital requirement. But in the main, we expect that it'll probably be a biting effect and it'll have higher capital requirements. One of the things that companies have strived to do or are looking at is if they bring companies within the same group together on one balance sheet, you achieve the diversification and as a result get some capital efficiency. So it is a driver for a lot of corporate restructuring. Interestingly, Solvency II hasn't really had any impact to date in relation to the customer offerings. We in Ireland have done a survey of business leaders and they have had implications for products of changes in the regulatory regime has been like towards the bottom of the items impacted. And we just spoke at our panel and I had a person from Aon in Luxembourg confirm the same thing. Really, customers buy insurance products for their own risk requirements. That hasn't changed and they'll continue to demand the same products. In terms of what might come and bite people in terms of surprise between now and implementation, I think that some companies might not have understood the information requirements in relation to Pillar 3. And I think when they go through the forms that they need to fill out, they might find that there are certain amounts of information which they mightn't have access to, which they will need to go and get.
For more of our coverage of the 2015 European Insurance Forum, visit the DEMA website or the special 2015 EIF channel in the RIN TV On Demand library.